A very good afternoon to everyone. Today in this video, we'd be discussing the meaning of economic value added, formula for EVA calculation, the elements of EVA, and ways to improve EVA. Quickly moving on to the meaning of EVA. Economic value added is the surplus value created on a given investment. It measures the actual profit that the firms make, which is calculated by finding out the difference between the operating profit and the cost of capital. It is a measure that reveals the financial performance of a business based on its residual value. Now, what is this residual value or residual income? This residual income is derived after deducting its cost of capital from its operating profit adjusted for taxes on a cash basis. Economic value added aims to define the value of a company generates with the help of the invested funds and improve the generated return for the shareholders. The formula to compute EVA is we can calculate EVA with the help of the EVA equation. The EVA equation goes like this: net operating profit after tax minus capital invested into weighted average cost of capital, that is WACC. Capital invested into weighted average cost of capital stands for the cost of capital, and this cost of capital is deducted from the net operating profit to arrive at economic value added or the economic profit or the residual wealth. So there are three important components of EVA: the net operating profit after tax, the capital invested, and the weighted average cost of capital. The net operating profit after tax indicates the theoretical income with no debt or tax obligation to bear. Capital invested signifies the funds the firm raises by issuing securities to the investors. And weighted average cost of capital refers to the money that is spent to maintain the resources and finances for operations, wherein NOPAT is equal to net operating profit after tax. WACC is weighted average cost of capital, and invested capital or capital employed is equal to equity plus long-term debt at the start of the period. So economic value added basically is based on the idea that a business brings profit when it creates additional wealth for the shareholders and leads to higher returns than the cost of capital. So now, as we all know how to calculate EVA, it is now time to review the several ways of increasing EVA. EVA can be increased by increasing the revenues of the business or reducing the capital expenditure. To increase revenues, there are two popular methods of increasing the revenues: increasing the price of your products or increasing the number of goods sold to your target audience. Now, let's see how which is best, either raising the prices of the products or increasing the number of goods sold to your target audience. If the prices are increased, the profit margin increases. Yet this possibility is ruled out because the customers might refuse to pay more for the product if the quality or the features or the benefits of the product are not enhanced. In this case, there is a high probability of decrease in demand and as a result, a decrease in the revenue. That's why it is advisable not to increase the prices drastically. However, it is the revenues by selling more goods and services is the best way to increase the revenues. So increasing revenue by increasing the number of goods sold to your target audience is the one or the best method of increasing your profits. So to meet the demand, considerably number of products need to be produced and ensure that manufacturing cost does not exceed the revenue you can receive. In other words, it means that to improve your EVA by increasing the company's profit, make sure that the marginal revenue is bigger than the marginal cost associated with the production. For example, there is no profit in spending $2 lakh on production to earn $1,50,000. As I told, the next way of increasing the EVA is by reducing the capital expenses. So the capital expenses like rent, interest rates, or by reaching the economies of scale, one can decrease the or reduce the capital expenses. For example, an entrepreneur decreases operating expenses by asking his creditor to revise the terms of the contract and the interest rates. If interest rates are lower, so you are going to pay less money as interest and you would have more profits at your end. Another instance of reducing capital expenditure is negotiate a lower cost for the space or you rent for your business purposes. And and another example is reaching economies of scale can empower the company to improve the marginal productivity. So with this, we come to the end of the video. See you soon in the next video. Thank you.